Good morning, all. Welcome to the series of lectures on financial derivatives. Let me introduce myself. I'm R.V. Rashikar, working as Assistant Professor in Srivastava Engineering College, Tadepalligudem, in the Department of MBA. Now, this is the first lecture on my series of lectures. I'm going to deliver today financial derivatives and types of derivatives. It includes what is the meaning of financial derivatives and what are the various types of financial derivatives. In financial derivatives, it is simply known as FFOS, forward, futures, options, as well as swaps. These four are known as the types of derivatives. Let me start the first topic. What is financial derivatives? That is a question we are going to face. What is financial derivatives? We can understand the financial derivatives in three ways. Financial derivatives as a market, means a derivatives market. Financial derivatives as a contract, financial derivative contract. Financial derivative as a instrument, derivative instruments. Let us get into the details of each and every type of understanding. Now, let me start with what is financial market. What is financial derivative market? Now, let us go with this. I am going to start with the basic concept of market. What exactly the market? Now we are having so many definitions of market, but it is a definition best suited to explain about the financial derivatives market. What exactly the market? Market is simply an arrangement to transfer four aspects: goods, services, funds, and risk. Now in market, in the sense, basic underlying feature of the market is, in every market we have the two parties. Two parties gather together in order to transfer the goods or services or funds, or sometime it is a risk. Now we are familiar with the goods market, we are familiar with the services market, we are really familiar with the funds market, but we are not familiar with the risk market. How the risk is going to be marketed, how the risk is going to be buy, how the risk is going to be sell. That's exactly point we are looking into. The market where the risk is bought and sold is simply called it as a derivative market. Let us understand with some example. Now let us take two parties. So party A, party B. They are into the market. What they are going to do? They are going to exchange. What they are exchanging? They are exchanging goods. They are exchanging services. They are exchanging funds, or they may be exchanging to the risk. Now one person may be a buyer, another person may be a seller. Normally in every market we see two parties. One person is a buyer, another person is a seller. What he is going to do? He is going to sell the goods to second party, and in return he is going to receive cash or some other aspect. Maybe he is going to provide the services and in return he receive the cash. Maybe he provide the funds, in return he receive interest. Sometime he receive, in the sense he transfer the cash, in return he gets certain benefit. Now let us understand what are these four are. We have a market which are using for goods are known as commodities market. Commodity market is a market to exchange goods. Now what are the commodities market? In our regular life we have so many commodities market. Now let us understand about the commodities market in detail. The commodities markets are broadly divided into four types: agriculture commodities, energy commodities, metal commodities, and other commodities. What is agriculture commodities? Agriculture commodities are the market where agriculture outputs are going to be traded, like wheat, rice, pulses, vegetables, as well as other commercial crops like sugarcane, cotton, and other commodities are going to be sold. Here the parties enter into the market in order to buy and sell those commodities. That is the first type of market. Second type of market, energy commodities. Energy commodities market is a market which is used to purchase energy related commodities. Let me explain what are the energy related commodities. We see coal. The examples are coal, crude oil, brown coal, gas. We are having so many other types of energy commodities. Now it is one of the very important market where most of the economies, both emerging economies as well as other economies, are engaged with. They are continuously buy coal, they are continuously buy commodities, they continuously buy crude oil in order to provide provide sufficient energy supplies to their entire country or the nation. The third one is metal commodities. Here the metal commodities we can divide into two parts. The first metal commodity is industrial metals. Industrial metals like iron, zinc, aluminum, other metals which are used for industrial purpose. We are having another categories of metals, that is the precious metals. We use the gold, silver, platinum and other metals we use for what is called as some luxury purposes. Those market is also called as a metals commodities market. In metal commodities market, which is used to buy and sell both industrial commodity metals as well as precious metals. We are having other commodities market. In case of any other commodities are available, those markets are like water. Sometimes we are going to purchase and buy and sell the water or some other things that comes under the other commodities. Now, the market for all the commodities are simply known as the goods market, that is known as a commodities market. That is a one part of markets, commodities market. Let us go with the next market. What is that next market? Services market, where the service is going to be transferred from one person to the another person. In return, he receive the cash or other benefits. Now, what is a services market? In regular life, we need to take the assistance of so many services like hospitals, banks and other services like resorts, hotels. These are all the services, transportation. Clear? All these services comes under the services market. Clear? Now we have the other and very important market in financial arena, that is what is called as the market to deliver the funds. The market is known as the financial markets. What is a financial markets? Financial market, let me take some examples. We have two parties. Party A and Party B. It is a common phenomena in every economy that they are going to do two activities. One is go for borrowing, go for lending, or transfer the money from one end to the another end. This is a common phenomenon. Every entity in economy, it may be individual entity or it may be organization, it may be corporates, it may be government, it may be quasi-government bodies. Whatever may be the form of entity, everyone requires some money. If they require some money, they need to go with the funds market, where the name of the fund market is called as a financial markets. What exactly do the financial markets? In financial market, we can borrow money, we can lend money. It includes a lot of markets. All the banks comes under the financial markets, means a fund market. Like mutual funds comes under the financial markets, as well as insurance companies, the stock market. We know that well known. The stock markets and other markets comes into the financial market. Now let us have a brief understanding about what are the categories of financial markets. Now we can divide the financial markets into two ways. One is a capital market, the second one is a money market. Capital market. What is a capital market? If a person or organization require a fund for greater than 1 year, more than 1 year. If a firm require funds of more than 1 year, they need to go for borrowing through banks, or they may issue equity share, they may issue bonds or debentures. It is a market to procure the funds which are having the maturity of more than 1 year. Such a kind of market is known as a capital market. Examples of capital market is a stock market. Stock market is one of the best example for capital market. We have the financial institutions. Financial institutions in India all comes under the capital market. In capital market, we have another markets, two markets classification. It may be a primary market or secondary market. In due course of my lectures, I will explain about what is the difference between primary market and secondary market. What is another kind of market? Another kind of market is a money market. Money market is it is a market for very less time. Very less time means the market is for less than 1 year. It is ranging from overnight to the 1 year. Means if you want a loan or otherwise a funds for 1 year, you can less than 1 year, you can go for money market. If you want a loan for 10 days, you can go for a money market. Or overnight means you borrow today and you are going to pay tomorrow. That's also you are going to go for money market. In simple word, we can say that capital market is a market for long-term funds. Money market is a market for short-term funds. Entirely this is known as a financial markets. Now, as of now, I cover three markets. Goods, that's a commodity market. Second, services, that is a services market. Third, funds, that is known as a financial markets. One is a basic underlying feature of all these markets are they are dynamic markets. They are dynamics. Dynamics in the sense, the various factors in those markets are continuously changing. What are changing? The changing things are, the prices are continuously changing. If you take commodities, let me take wheat as an example. The wheat price are continuously changing. Or let me take gold as an example. Gold price are continuously moving. Crude oil is an example. It's a continuously moving. What happens if it is continuously moving? If the prices are variable, what is going to happen? Now, maybe this party or otherwise this party, maybe on what is called as a you or otherwise a opponent point, having a risk because of the changes into the price movements. One thing you need to remember, the price movements may be adverse, may be favorable. A favorable price movement will give you the profit. A unfavorable price movement will give you the loss. Now, an unfavorable price movement we can consider as a risk. That is not in your hand. We are not going to predict what is going to happen to the next day. We are not going to predict what is going to happen to the next month. That's why we are in position to handle our risk. Once we are in a position to handle our risk, we can manage our returns, manage our profit, manage our cash flows. Sometimes it is not possible to handle our risk. That's why we need to take another market. The market is known as a risk market. The risk market, the market which is used to transfer the risk from one party to the another party. Means here the parties are accept the risk, here the parties are accept the risk. Your risk is going to be accepted by me, my risk is you must accept. Then we are going to enter into a contract. We are going to enter into a market. Such a kind of market is called it as a derivatives market. Let us have a snapshot of all the things. Let us have a snapshot of the things up to now. Commodities market, services market, financial market. These three are the dynamic markets. Means the prices are continuously changing. Agriculture commodities prices, energy commodities, metal commodities or other commodity prices are changing. If you take financial markets, what is the key? What is the criteria we are going to consider? What are the things we are going to consider for financial markets? We are going to consider for interest rates. In financial markets, most of the cases we are going to consider for interest rates. What about the interest rates? Interest rates may be constant for short run. Interest rate may be what is called as a variable in some other time. There are two types of interest rates in normally. Floating interest rates as well as fixed interest rates. If the interest rates are keep changing, there is a risk with the people who are holding this financial markets. Means the borrowers, there is a risk for borrowers, there is a risk for lenders, there is a risk for issuers, there is a risk for the people who are dealing with financial instruments like bonds, shares, as well as other financial instruments. Now, in order to save, or otherwise in order to make ourselves secure from the adverse moment of these three markets, we are going to create another market. Such a kind of market is known as a derivative market. Let me snapshot what exactly derivatives market is going to do. A derivative market is going to transfer risk from one party to the another party, and in vice versa, another party is also transfer his risk to the another party. Here the people ready to take the risk and transfer the risk. One people need to take the risk, another party need to transfer the risk. Because of the transfer of the risk, one person maybe have a gain, the gain of the one person may be a loss of another person. In vice versa, the loss of one person may be a gain for another person. That's vice versa. Means a favorable price movement will give you the gain for the X party, and the same way it may be the loss for the Y party. An unfavorable price movement may give to the loss to the X party. In the same way, the same movement is going to be gain to the X party, Y party. This is the thing you need to understand. Finally, what is a derivative market? Let us come up with the point. Let us come to the point or key point in what is derivative market. What is a derivative market? A derivative market is a market developed over a time to transfer the risk from one party to the another party. The main object of any kind of derivatives market, it may be F&O market, it may be swaps, or it may be forwards, whatever may be the market, sorry, whatever may be the market is meant to transfer the risk from one party to the another party. The people who assume themselves is going to face a risk, they can take the assistance of the derivative market to hedge themselves against the risk. This is the first part. In this first part, I covered derivative market. Hope you are clear about the derivative market. Once you clear about the derivative market, I am going to come up with the second meaning. The first meaning is over derivative market. Shall I go with the next meaning? Now, I go with the next one. Now, we can understand derivative as a contract. Derivative as a contract. Let us understand what is a contract and how it's going to be drawn and delivered. It is a contract. Derivative is a contract. Now, what exactly a contract? Contract is basically an agreement between two parties. Are you clear now? Here the one party, here the second party. Party A and party B. Any agreement, are you clear now? There may be an acceptance by both the parties. The party A need to accept and party B need to accept. Under derivatives market, the parties are known as counterparties. Counterparty A, counterparty B. Two parties need to enter into a contract. The contract is known as a derivative contracts. Now, for what purpose they are entering into a contract? The purpose already explained in derivatives market, to transfer the risk. Let us understand what is a derivative contract in detail. Derivatives are the contracts whose value is based on or linked to, derived from underlying asset. Try to look at the definition at once. And again, derivatives are the contracts whose value is based on. The contract value is based on, or it is linked to, or it is derived from underlying asset. Means it is a contract which is completely depends on UA. What is that UA? UA stands for underlying asset. Now, the contract value is based on, linked to, derived from underlying asset. Now, here the things you need to understand more about what is underlying asset, what exactly it is. Let us go back to the previous slide. Now, we said a goods market. What is a goods market? Goods market is known as a commodities market. Let us take one commodity. I am going to take coal as a commodity. I am going to take a coal as a commodity. Now, what happened to the coal prices? Coal prices are continuously fluctuate. It may be increased or it may be reduced. Now, as a party, you feel that you are holding a coal and future is uncertain. If the price is favorable, you get the gains. If the price is not favorable, that may impose a losses to you. What you are going to do? What you are going to do? What you are going to do? You must take alternative action in order to hedge yourself, in order to save yourself from the adverse price movement. That's why you can enter into a contract with with coal as an underlying asset. Coal as an underlying asset. As a coal as an underlying asset. Now, you are entering into a contract with a coal and as a coal as an underlying asset. It means that your contract value is purely based on coal value. Now, here it may be a lot of confusions because both are coal. We are entering into a contract with a coal and the underlying asset is a coal. Now, in order to understand the better things, then we need to understand with a practical examples. And once I cover this, I will explain with a practical example. Now, let us go with, we have a counterparty A, counterparty B. They enter into a contract to transfer the risk. In order to transfer the risk, what contract they are entering? Derivative contract. The value of the derivative contracts is derived from underlying asset. I said it is based on, the contract value is based on underlying asset. It is linked to the underlying asset. It is derived from the underlying. So what does it mean? If the underlying asset price is increases, the contract value is also increases. If the underlying asset price reduces, the contract price is also reduces. Let us take commodities as an example. If the wheat price is increases, Now, if the wheat is an underlying asset, then underlying asset value is also increases. Now, if the underlying asset wheat prices increases, the contract price is also increases. If the wheat prices reduces, contract value is also reduces. In the same way, if you take equity share as an example, like if you take BEL as an example, Bharat Electronics is an example. If the Bharat Electronics as an underlying asset, the value of the contract you entered for Bharat Electronics. Now, if the Bharat Electronic price is increases, the value of the contract is also increases. If the Bharat Electronics or reduces, the value of the price is also reduces. Some cases we can take an example of index also. You enter into a contract for Nifty 50. Now that is a contract. The underlying asset value is a index itself. Now what happened? If the Nifty is increases, then contract value is also increases. If the Nifty is reduces, contract value is also reduces. That's why it's a completely depends on underlying asset. Now let us get into the details of the underlying asset in the later course of the session. Now what may be the common underlying assets? These are all the common underlying assets. We can take stock as an underlying asset if you feel you have a risk because of the stock. Sometimes you can take a currency. Currency market is also comes under the fund market. Clear, no? The currency is also underlying asset, like currency pair like USD INR, GBP INR. These are all the currency pairs. If you feel the currencies are continuously fluctuating, because of the fluctuations, if you feel it is a risk, then you can take the help of the derivative contract to save yourself from the risk. The next one is the commodities. Next, ETF. ETF is a kind of mutual funds which is traded on stock exchange. ETF means exchange traded funds. All the mutual fund companies, they are using ETFs, but in India, ETF is not used as underlying asset as of now. Clear, no? But in other countries, in developed countries like in USA, in Europe, clear, ETFs are also using as a underlying asset. Now indices. Indices means an index. Our index like Sensex, Nifty, Bank Nifty, Finance Nifty, all those indices also we can take it as a underlying asset. Bonds also we can take it as an underlying asset. Interest rate is also we can take it as a underlying asset. These are all the common underlying assets. Are you clear now? For these underlying assets, your contract value is going to be linked. Hope you are clear about this. Now, let me recap the things again. What is a derivative contract? Derivatives are the contract whose value is based on, linked to, or derived from an underlying asset. Clear now? Now, there is two counterparties. They are enter into a contract to transfer the risk. That is known as a derivative contract. Now, the value of the derivative contracts depends on underlying asset. The most common underlying assets are stocks, currencies, commodities, ETFs, indices, bonds, and interest rates. Now, this is end with the second understanding about the derivatives. First, I said derivative market. Now, I explained derivative contract. Now, we go with a very, very important definition and the most commonly used definition for derivatives, that is known as a derivative instrument. Derivative instruments. Students, you must remember that this is a common used definition of derivatives. What is a derivative instrument? Now, what do you mean by instrument? Tell me some common instruments. Now, we are having so many instruments like equity share is an instrument, bond is an instrument, preference share is an instrument. These are all known as the instruments in financial markets. Fixed deposit is an instrument. In the same way, derivative is also an instrument. Are you clear now? Now, the value of the instrument is derived from underlying asset. Same I discussed in previous slide. A derivative is a financial instrument which derives its value from an underlying asset. Again, the same I list out what are the common underlying asset. The value is derived from underlying asset. Okay. Derivative instruments are the different types of contracts available in derivative market used for the various purpose. We enter into a contract for various purpose. It may be primary purpose is to transfer the risk, but some people they enter into a contract only to take the risk and advantages from the risk. They enter into a contract for the purpose of hedging, speculation, and arbitrage. Some people, they enter into the contract only purely save themselves from the adverse price movements, that is known as a hedging. Some other people, they want to gain an advantage, that is known as a speculation and arbitrage. These are all the purpose. And what are the contracts are available in stock market? Common contracts are, in simple nutshell, it is known as, in simple nutshell, all the derivative contracts are simple known as FFOS. FFOS. What do you mean by FFOS? Forward, futures, options, swaps. We have the four contracts. We have the four types of contracts, the same as known as the four instruments: forward instrument, future instruments, option instruments, swap instrument. Commonly used market in stock market is F&O market. We are familiar with the F&O market. Most of us are familiar with the F&O market. What is F&O market? It is a market for futures and options. Now, what are the two other markets? Two other markets are there. We are not having the trade in stock market. They are the different markets, that is called it as a forward market and what is considered as a swap market. Now we have the four types basically. Let us understand the brief idea about what is a forward market. We use some financial terminology here. Forward market, basically OTC market. OTC means over the counter market. Over the counter means we have two parties here. If they directly enter into a contract without having any intermediary, without having any middle person or middle institution, the market is known as the OTC market, over the counter market. Means there is no intermediary, you are directly entering into a contract with the other party. Forward is such a kind of party, means where parties are directly entering into a contract with the other parties. Now it has a forward commitments, obligatory contracts. Forward commitment in the sense, once you are entering into a committed for a particular aspect and you need to fulfill those aspects. I will explain later in the next slide. Clear now? Now what is a future? There is a slight difference between the future and forward. Now again here we have the two parties, party A and party B. Both are entering into a contract but not directly. They are entering into a contract through stock market. They are entering into a contract through stock market. Means A party enter through stock market, B party is also entering into a stock market. Means between counterparty A, counterparty B, there is a intermediary mechanism. The mechanism is simply known as exchange. That's why what kind of contract it is? Exchange traded contract. Basic understanding. Forward is a OTC contract which we can directly enter into a contract with other parties if the other parties agree with your terms and conditions. Future contract, the contract we can enter into a third party or a second party through an intermediate like a stock exchange. Means suppose take an example, if you want to enter into a contract with Bank Nifty, you can enter through NSE, stock exchange. Now the counterparty is also enter through NSE, means between you and other parties there is an intermediary. The intermediary is known as a stock exchange. If there is any intermediary regulatory body or otherwise, it's not exactly regulatory body, intermediary institution is there, such a kind of contract is known as a future contract. Clear now? Now options as well as swaps. Options means you have an option. Clear now? You may execute the contract or not execute the contract. Later I will explain about in details about the options as well as in the meanwhile try to understand what are the four types of contracts. This is also contract, this is also contract, options is also contract, but these two are compulsory commitments, means you need to fulfill the contract. Options you may or may not, depends on the particular aspect. If the option is favorable, you can execute the contract. If the option is not favorable, you can lapse the contract, means you can leave the contract. The option is given to any of the party. Are you clear? It may be A party or otherwise a B party, not for both the parties. We have a swaps also. Swap. Now swap is also OTC, means it's like same as forward contract. Means it's a direct contract from one person to another person without having any intermediary. Now what is that? It is a forward commitment obligatory contract. It's a basically forward contract as well as the obligatory contract. Obligatory means a compulsory as well as it is a forward commitment. Now In option only, you may or may not, but what about remaining forward, future as well as swaps? You must. Once you enter the contract, you must fulfill the contract terms and conditions. What about option? If it is a favorable, you can fill. If it is not favorable, you are not going to take the contract. From this lecture, you need to understand the basic essence of, are you clear now? What is the meaning of financial derivatives and what are the various types of financial derivatives like forward, future, options, and swaps? In the coming lectures, I am going to explain in detail about the forwards, futures, options, swaps with features as well as the examples of the various contracts. Are you clear? Thank you for all.